This will be our introductory module into healthcare finance, where we'll start to build that foundational background and talk about terms that are related to finance and accounting in healthcare. Now, each slide will not have a voice recording to go along with it, but a little microphone will show in your bottom right-hand corner on slides that do have a little bit of supplemental information to go along with the information presented. But please make sure that you are reading the text to fill in the gaps and fill in the information that we cover on the slides. I will typically have an agenda for each module that'll outline what we'll be discussing during the course of that module. And you can see that agenda laid out here. The course organization, defining healthcare finance, we'll talk about finance activities, deal a little bit with regulatory and legal issues, and then talk about challenges within healthcare and sum it up with some key points. Now, accounting in healthcare is really considered to be one of those functions that records economic events. So, the information that we get from accounting can be used to analyze really how well overall our organization in particular is operating and how well overall organizations that we compete with are operating. We can also use accounting and the techniques in accounting to create external reports for our organization to help further with that analysis that we need to conduct. And for a business that we really consider to be for profit, accounting works to create more stock reports and stockholder reports that we deliver to the SEC, where in non for profit, we don't have stockholders, so we won't have stock reports to distribute. Now, financial management in healthcare is more along the lines of using internally created reports that we use to assist us really in improving our overall business organization. So, we create those reports through financial management and really utilize them to help us with the organization in terms of managing it more efficiently. So, the difference between healthcare accounting and healthcare finance management, the two can really be codependent, and certain sections of accounting are really used in decision making for the organization, while a lot of the application of financial management requires that accounting driven data. So when we talk about capital budgeting, it's important here to understand that we're talking about money that we essentially borrow that we cannot pay off within a 1 year span of time. So this finance activity revolving around capital budgeting is going to be primarily focused on how we acquire and our acquisition of buildings, of land, of equipment, and different larger purchases such as that. And really, decisions for capital purchases are going to be weighed on what's presented in our financial report. So, essentially, can we afford the things that we need to buy from a capital budget perspective? So, to give you hopefully a relevant example, as a college student, we know finances are tight. But we need to consider buying a new car. We need a new car. And we went out and priced one, and the one that we want is going to cost us about $15,000. So if you're going out to buy a new car, the first thing you would want to do is review through your revenue or your income. So we can see that laid out here at the top. We have our job, or our different jobs that we have, brings in about $8,000. We have scholarships or donations from scholarships or our parents for $2,000 a piece, and then we have some debt from loans in the amount of $2,000, which gives us about $14,000 of revenue. And then when we look at our expenses, we have about $7,000 for tuition and books, $3,000 for housing. We have no expense for transportation, which is why we're buying the car. And then our food and entertainment are about $1,200 a piece. So our net income from this would be $1,600, and we simply take our revenue minus our expenses. So we know we have a disposable income or a net income of $1,600, and now we just have to make a decision to purchase the new car based on the information we just discovered through our financials. So is $1,600 enough to make that monthly payment on that new car? What are the benefits and the downfalls of buying this new car, and can we take that disposable income to afford that? So when we look at the difference between larger organizations or multi-facility organizations and more of our smaller organizations, we may start to wonder, why is it harder for smaller organizations to borrow money as opposed to what seems to be an ease of larger organizations to borrow money? And it's simply because it's harder for these smaller organizations to borrow money because they have less assets. So if you think about a large multi-facility organization, they have a lot of assets that they can kind of leverage or to put up as collateral for borrowing this money, whereas smaller organizations don't necessarily have all of those assets that they can put up. Now look on down through financial risk management, and I want to note here and just point out that financial risk management, we need to think about this more in the perspective of financial risk management is really controlling how much risk financially we take as an organization. And this is typically led, if we talk about larger organizations, by the CFO, and we usually have a comptroller who looks at our accounting functions, and a treasurer who looks at our investment and our borrowing decisions. And all those positions report up to the CEO or CFO. Now, in smaller organizations, the practice manager typically will handle that responsibility. And when we look at the structure of healthcare service settings, we have four primary types of settings in health services. So the first one I want to review is our hospital setting. And this is really going to encompass two main categories that we can consider, which is general acute care hospitals and specialty hospitals. So we have hospitals are also additionally classified into three main categories. So we have the two main categories of hospitals, which are general acute hospitals and specialty hospitals, and then they're further on classified down into three main categories overall, which are non-for-profit hospitals, our government hospitals, and our investor-owned hospitals. Now, government hospitals are typically going to be those hospitals like the VA or the Veterans Administration Hospital, or hospitals that we have operated by the military. Now, roughly 80% of all of our private or 60% of all hospitals are considered non-for-profit organizations and facilities, and that remaining 20% of private hospitals are going to be more of our investor-owned facilities, and that really just means that there's investors that benefit as a direct result from the profits of that organization. So a good example would be Community Health Systems out of Nashville. It's a very large multi-facility, multi-state hospital system, and this is an investor-owned hospital system. So there are stockholders. They are not considered non-for-profit, so they're beholden to some type of investor. And then you have a system like Mountain States Health Alliance, which is a non-for-profit organization. Now, the second type of health service setting that we're going to discuss is an ambulatory care facility. These are going to be things like your physician practices, your surgical centers, your urgent cares, your clinics, and entities such as that. And when we look over the past couple years, we've actually seen a drastic increase in the number of ambulatory care facilities over the past couple decades. And we really attribute that to technology as one of those leading factors for expansion of our ambulatory care facilities. Now, our long-term care facilities are going to be things like our nursing homes, mental health facilities, our rehabs, and these facilities are going to be primarily concerned with the patient's ability to conduct their activities of daily living, or their ADLs. In a long-term care facility, patients usually end up there, once they or the individual or the family, for an instance, are no longer able to really perform those activities of daily living or those ADLs. That individual is then considered a good candidate for these long-term care facilities. And then our last type of health service setting is an integrated delivery system, which we shorten to IDS. And really an IDS, you can think of it like a health system. So we have an IDS that is a single organization, and that can be like your Mountain States Health Alliance or your Wellmont Health System, which really offers a broad range of health services, but we do it in more of a unified manner. And IDS organizations are able to offer payers a really complete package for services. So payers meaning insurance companies, so their patients aren't needing to go between several different services, and insurance companies are not having to make several different payments. They can make one payment to the IDS. In addition to that, the IDS, another advantage with it, really provides the organization better access to capital for their organization. So think back to why we said smaller organizations have a hard time buying or borrowing money rather. It's because they don't have a large amount of assets like our larger organizations. Now, if you were to join up with an IDS, an integrated delivery system, you would open yourself up to having access to more assets, which would help increase your borrowing leverage. Now, I'm not going to talk about investor-owned corporations much throughout this course because, as we just said, a large majority of health systems are non-for-profit, but I think it's important to give you a background or give you a foundation or an understanding of what investor-owned corporations are. So we'll cover that off and on, but we won't make it a main focus of this course. So the first thing I want to talk about here, you can review what a stockholder is, and essentially it's a person who owns one share of stock of a company. But stockholders have 6 main rights, and I want to make sure to cover them through this module. Now, the first right of a stockholder is their voting power they have on major issues with an organization, and that includes electing your positions like your board of directors, your president, the trustees, positions like that. Now, voting typically takes place at a company's annual meeting. If it's an investor-owned corporation, they will have annual meetings. And shareholders, like I said, can vote on major issues like electing representatives to the board. But shareholders do not have to be present to make those votes. They can vote by proxy, and usually that's done through a ballot in the mail. Now, the second type of stockholder right to have is that ownership in the portion of the company, so you essentially own one piece of the company. Next, we have the right of transfer of ownership, and that simply just means that shareholders are allowed to transfer their stock on the exchange. Now, the fourth right is the stockholder's right to entitlement of dividends. And what this means that along with the stockholder's claim on assets for the organization, they also can claim any profits that the company pays out in the form of a dividend. So at the end of either the physical year or the fiscal year, based on how the company performed throughout that year, the company may issue dividends to any stockholders for the organization. Now, the next right for stockholders is the right or the opportunity to inspect the corporate books and the records, just meaning that at any point in time, they can go in and as a shareholder or as a stockholder for the organization, they can go in and review the financial documents for that organization. And the sixth and the last right is the right to sue for wrongful acts, and this usually takes the form of a shareholder class action lawsuit. Just as with everything else, there are advantages and disadvantages to both the proprietorship and the partnership. So some of the disadvantages here are going to be the life of the business is also limited to the life of the owner. So once that owner passes away, the business essentially does the same. Now, it can be difficult also for owners to sell their interest in the company. And then both types of the organization, proprietorship and partnership, also have unlimited liability. Now, for the proprietorship, the owner is personally responsible for all the debt incurred, whereas in a partnership, if one partner is unable to meet their proportion of the obligation, let's say, or they can't meet their proportion of the responsibility, the other partners are then going to be responsible for all unsatisfied claims. So if there's debt on behalf of one partner, and they can't meet that debt payment, all other partners within that organization are going to be held liable. Now, it's important to understand that corporations are an entity that have an unlimited life. And what that means is that the corporation is going to essentially live on, if you will, even after, managers and owners or even the shareholders decide to move on, or even dissolve the corporation, or if the corporation undergoes a merger with another company. Now, it will be easier to sell or merge a corporation simply because it's a matter of changing shareholders, rather than needing to go in and establish an entirely new business structure. Now, corporations do have something called limiting liability, and this is where the owner is not personally liable for things like the So I'll give you two different examples that kind of differentiate between a scenario where we have an LLC and a scenario where we have a PC or a PA. So let's say, for example, we have two surgeons, Dr. Parker and Dr. Stevens, and they have a practice together. And one day Dr. Parker is completing a surgery, and unfortunately Dr. Parker leaves an instrument inside that patient. And as a result, that patient unfortunately bleeds out and bleeds to death. Now, the family, on behalf of the patient, can bring a malpractice suit against Dr. Parker and the partnership, which they do, and the jury comes back and decides to award them a $2 million verdict against Dr. Parker and the partnership in favor of the patient and their family. Now, let's say the practice only has about $1 million in malpractice insurance to work to cover that $2 million judgment. Now, if we're in a limited liability company, Dr. Stevens, along with Dr. Parker, who was initially named in the suit, would be personally liable for the $1 million that's not covered by their insurance. So this would be a scenario where this would be a type of limited liability company where Dr. Stevens, even though they were not involved with the surgery, but because they are in a partnership, they would owe or would be responsible for the $1 million not covered by the insurance. Now, if we look at the reverse of that, and we say, again, Dr. Parker commits this malpractice where they leave the instrument in the patient, they have the suit, and the jury awards that $2 million verdict. Dr. Stevens, in this different scenario, would be considered a corporate employee under a professional corporation or an association. And because the organization is set up as a PA or a PC, Dr. Stevens would not be personally liable for that portion of the verdict. So they would not be held liable for that additional $1 million that's not covered. But Dr. Parker, however, would still have that personal liability for the $1 million in excess of the $2 million verdict, because Dr. Parker was the one guilty of malpractice in this scenario. So when we start to think about all the issues that revolve around the current situation we see ourselves in healthcare and why we find ourselves in the position that we're in, the list can really be narrowed down to a couple main key points. One of those can be inappropriate or improper utilization of services, whether that's on the patient's end, with overuse or improper use of services like your emergency room, or if that's on maybe the provider or the clinical end with overprescribing of medications or overprescribing of tests, CT scans, MRIs, things like lab tests that the physician feels like they need to be done because they're starting to practice a little bit of defensive medicine. We can talk about the under or the uninsured, which has been a big issue that's kind of led us to where we're at. So we have those that have no insurance or those that are underinsured, so don't have the right level of insurance that they need. We have a lot of issues, particularly around reimbursement revolving around Medicare and Medicaid. We don't get our full reimbursement. I think it's about 80 cents on the dollar that we get reimbursed from Medicare and Medicaid services. And two, to go along with that, the fraud and abuse that we see, not only with Medicare and Medicaid fraud, but overall in the healthcare industry at all, overall. Another big one, kind of outside of our control, is our aging population. So if you look at the population trends across the country over the last couple of years, we see this huge aging population, the baby boomers. They're about to retire, which we know older generations and older populations use about 2 to 3 times more healthcare services than our younger populations. So that's going to start to put a strain on our system. And then just the advancement of technology that we're starting to see. So everything's becoming more technologically advanced, which is a good thing, but we have to start investing a lot more money in infrastructure and a lot more money in technology and training, things like that, which can drive up the cost and start to cause a couple issues in healthcare. If you think about us being on electronic medical records now, what do you do if the technology goes down or if the technology fails? So just a couple things to consider when we start talking about why there's so many issues in healthcare. Now, the trends that we're trying to offset or that companies are offsetting, employers are offsetting that we're starting to see is they're trying to offset insurance costs to the employee. So it's starting to become a lot more expensive, especially with the new healthcare law and mandates coming through for employers to offer health insurance. And so they're trying to pass those costs on down to the employee overall. The last point I want to talk about down there, the competitive market model. If you're not familiar with the competitive market model, just wanted to go over this. Competitive market model is what we really strive to have in healthcare, though we have a couple different aspects that make it a little more difficult for us to have this type of model. So in a competitive market model, we have pure information. There's open transparency. And in healthcare, we really don't have this information to work for perfect competition. So we can't just go out and see what it's going to cost hospital A to do this surgery for us versus what it's going to cost hospital B, because we have that third party, which is our private insurance in there, that kind of muddies the water on the true cost of services. So when we think about and start talking about more of these legal issues that we're starting to face in healthcare, we always have the liability issue, and providers in particular have the professional liability issue, which we've also heard called malpractice. Now, it's very costly to practice in medicine because you do have to take out that professional liability insurance. And those premiums for that insurance, depending on what field you practice in or where you practice across the country, can be upwards of $100,000 per year. And that's just in premiums to pay. That's not, extras that you might need to pay on top of that. That's just the premium to have the insurance. And when we look across, how many cases are brought forth in U.S. courts, every year, some frivolous, some do have some merit to them, but we have about 20,000 new cases per month just brought forward to different courts across the United States concerning malpractice. And those cases usually have an average payout of about $300,000 per case. Now, this is most often settled outside of the court system just because it's easier to negotiate and do this mediation without having to go to court. Now, if you think about how this changes or influences the way a clinician may practice, this has led to the practice known as defensive medicine. And if you're not familiar with defensive medicine, we had mentioned it earlier, or had hinted to it at least, where defensive medicine is more the practice where we as clinicians start to recommend maybe tests like your lab tests or your MRIs or your CTs, or maybe even some types of treatments that's not necessarily really the best option for the patient, but it's really the option. It mainly serves to protect the physician against potential malpractice lawsuits that may be brought forward, and that really works to add on to what we see as the cost of healthcare.